Hello everyone, in this video let's go through chapter 11, estimating the growth rate. Before we discuss three main methods of estimating growth rate, let's take a look at one example. Tesla. Everybody knows Tesla. You like their cars and I like their stock prices. Well, back to year 2019, as you see on this stock price chart, Tesla price is around $200. At that point, people say, hey, stock price is overvalued. Why? Because this company hasn't been able to generate any decent profits, and EPS, earnings per share, is about -$5. And for this stock, if you want to get a good sense of valuation, you have to have a good estimation of its future growth. I mean, what happened? What will happen is that investor actually believe that in the future this company will have tremendous growth for its sales and profits as well as cash flows. Although right now EPS is negative, it doesn't mean in the future EPS will be negative. And instead, investor estimate that this company will have tremendous amount of growth rates. So growth rates are very, very important variable in stock valuation. In the textbook, you often see, okay, growth rate 5%, 10%, terminal growth rate 3 to 5%. In the near term, company may have 10, 12, 15% growth rate. But for the company like Tesla, if you see its future growth around 20, 30, or even above 30% for the next 10 years, then you will see a very different valuation which has been captured by the market in year 2020. In year 2019, most people believe that Tesla stock price is overvalued around $200, and but you see at the end of year 2019, stock price didn't go down. It went up to $400. It's a 100% gain in just 1 year. But that's not the end of the story. In the early year 2020, it went up from $400 level to $500, $600, $700, and as high as $900. At that point, what do you think? Well, people say, hey, this stock is crazy. This stock is crazy, and $900, that's a ridiculous valuation. Well, other investors may disagree because they see tremendous growth of this company, around 25 to 35% for the next 10 or even 20 years. If you don't have a good estimation of the growth, then you won't be able to see the valuation in Tesla. And a lot of people actually don't do a lot of good work for growth estimation in this company as well as stock valuation, and they believe that at $400 stock price is overvalued and they short sold this stock. But look, when stock price move from $400 to $800 or even $900, you will see what happened to those short sellers. So let's go back to the chapter, estimating growth rate. Growth rate is very, very important for stock valuation. So how to estimate the growth rate? I mean, you can take any DAG. You can take any guess. However, you want to make sure your guess is a reasonable one and one of the best ones. Here we have three major methods estimating growth rates: historical approach, analyst approach, and a fundamental approach. Historical approach take a look at what happened in the past, and they believe that what happened in the past will repeat in the near future. For example, Walmart tend to have about 7 to 8% historical growth during the last 10 years, and since it's a mature company, an investor forecasts that in the future this company may have similar growth rates for the next 10, 20 years. Well, that's reasonable guess, and that's one estimation approach for the growth rate. You look at what happened in the past, and especially for mature companies, it's very likely that in the future it may repeat what happened in the past. So that is a historical approach. And the second approach is to look at what experts are saying. Those experts are financial analysts working for investment banks and equity research companies. And they often publish their research on individual stocks, and they will tell the audience and other investors what reasonable stock price should be, and they also will reveal their estimation of the growth. That is analyst approach. I mean, some analysts are really good, others may not be that good. From investors' perspective, you really want to look at a range of estimation from those analysts, and it's very likely that a very good estimation of growth rate should be something in between those low numbers and high numbers. That is analyst approach. And the last one is fundamental approach. Well, I don't think it's a good approach to estimate the growth based on the historical record, or even take reference from those analysts. Both are not reliable approach to getting a very good estimation. And here, as an investor, you want to have 100% confidence in the stock that you are going to evaluate or the stock that you're going to invest in. So let's go back to the fundamental approach. Fundamental approach emphasize the fundamentals of the growth. I mean, let's take a look at the growth. What will generate growth in a business? What will generate growth in a business? Well, I mean, there's many different ways the company can generate the growth, right? But fundamentally, there's only one way the company can generate the growth. Growth cannot come from thin air, and the growth can only come from one thing. That is reinvestment. Reinvestment. Company has to invest to generate its future growth, and the growth cannot be generated automatically. So we'll look at all three approaches, trying to get the best estimation of the growth. First of all, let's take a look at historical approach. And typically, investor will look at what happened in the past. They look at annual growth rates for the company during the last 10-20 years, and to take the average, and that average growth rate would be a good estimation for the future growth rate, especially for those cyclical businesses. Let's say the most recent business cycle lasted for 10 years, and you look at the average growth rate during the most recent business cycle for a mature company. It is very likely that the business cycle will repeat in the future. And let's say, hey, for the future 10 or future 10 years, which is about the cycle of a business, the time length of business cycle, then you probably want to use the historical number as the beginning point of your future estimation of this growth. Regarding the method, we have two major regressions. First one is linear regression. You regress EPS or log of EPS against the time to see what is the growth rate in the past. And the second way is to do the time series growth. But no matter which regression method that you're using, keep in mind that what happened in the past may not repeat in the future. And if you stick with the historical approach, then you would say, hey, what happened in the past will repeat in the future. That is a historical approach. And for analyst approach, well, analysts look at the fundamentals of business. They look at the firm specific information, macroeconomic information, information revealed by competitors on the future perspectives, as well as private information and other public information. And analysts working very hard on a daily basis, collecting all those information, trying to get the most recent estimation of the growth. And most financial analysts focused on large and liquid companies with more institutional holdings. They do pretty good work, but the past research revealed that on average, analysts' forecasts are overly optimistic. And typically, analysts may overestimate the growth rates of the company that they are analyzing. And that's the one big drawback by using the analyst approach, because if you adopt analyst approach, that means you might be equally overly optimistic on a company's growth rates. And for smaller companies, since there are less analyst coverage, then you may not be able to get a good number for the growth rate estimation for the smaller companies. And so that's the analyst approach of getting estimation of the growth. And typically, as a mature investors, you don't actually stick with one method. As I said in this class, it's all about detail dressing. And the more tools you have, the more methods you have, the more reasonable your estimation that you might get. So here we have two reasonable tools. None of them are perfect, but reasonable tools. First one is to look at what happened in the past. If you assume that what happened in the past may repeat in the future, the historical number of the growth rate might be a good indicator of its future growth rates. And the second, you look at experts' opinion. But keep in mind, those experts are overly optimistic. Right? So you look at those two numbers. But essentially, you wanted to have a fundamental understanding of the growth rates in company that you are going to analyze. So the last method is the fundamental approach. And the fundamental approach look at the business fundamentals of the growth. It addressed the very, very important issue about growth. What generates growth? What does generate growth? Well, there's only one thing, that is reinvestment. Company has to reinvest to develop a new product, or get into a new territory, or providing new services, or develop a new product, new services, or getting into new territory to get more customers and market shares as well. So in that sense, company can generate the growth. And the second way is to improve, so for the same store sales, they sell more services and products from one shop in a specific location. So that's the two main source of growth. First one is expanding the product services, or expanding the business into a new territory. Second one is for the existing locations, they increase sales. But no matter which strategy the company is using, they have to reinvest in new technology, reinvest in a sales force, reinvest in research, reinvest in manufacturing, and everything. In a nutshell, the growth can only be generated by reinvestment. So reinvestment is the source of the growth, and this fundamental approach will let you to look at the reinvestment aspect of the business, trying to get the best estimation of growth. And in your investment textbook or 3010 corporate finance textbook, you learn one equation that can help you to get reasonable estimation of growth rate. That is, growth rate equals retention ratio times ROE. Retention ratio equals retained earnings divided by total profit, and then you time this with return on equity to get an estimation of the growth rate. And this is a general equation that investor can utilize, but in this class I can tell you that this is okay equation, but not the best equation. The best equation is to look at the real reinvestment company they're going to conduct in the future to get a more realistic and a good estimation of the growth. Why is that? Because when you look at the retention ratio, there's a problem with the retention ratio, because when a company retains earnings, you assume that a company will reinvest all of the retained earnings into future investment. But actually, company may reserve a lot of cash from those retained earnings. So some cash may sit in there, not being invested into their new products and services. So this retention ratio times ROE may overestimate the growth rates of the company. You have to look at it; it's a real reinvestment activity. So the revised equation would be that the growth rate equals equity reinvestment rate times ROE. We look at the real reinvestment, not just the retained earnings. So how to calculate equity reinvestment rate? Well, you look at what is the reinvestment that the company is going to conduct. Well, there are 4 different components here. The first one is CapEx. What is CapEx? CapEx is capital expenditure. Capital expenditure. So in the future, if you see CapEx, that means capital expenditure. Capital expenditure is a very, very important item in equity valuation. And often when you attend a earnings release conference with the company and a lot of financial analysts may have deep discussion on what the capex will be for the next quarter or for the next couple of years with management teams of the company. And the second item is D&A. D&A is depreciation and amortization, and it's a non-cash charge, should be added back into our calculation. And the third one is change in WC. What is WC? WC is working capital. That's change in working capital, because when a company invest in those long-term projects, those are long-term investments, which is reflecting capex or capital expenditure. But in order to let a new investment project to operate, company still needed to invest in working capital, investing account of receivables, investing inventory, so on and so forth. So that is change in working capital. That's also a part of the investment company needs to conduct in the future. And the last one is change in debt. When you minus change in debt, you are getting the equity reinvestment. You are getting the equity reinvestment part of this equation. And equity reinvestment rate once again equals capex minus depreciation and amortization plus change in working capital minus change in debt divided by net income. And alternatively, if you use a free cash flow method or free cash flow to the firm method, you want to change your perspective a little bit from equity reinvestment to operating reinvestment. And here you look at both the investment by using equity and debt finance. So here you calculate the investment rate based on operating earnings, not based on earnings. And then timed with return on capital. What is capital? Well, capital equals equity plus long-term debt. And here, investment rate equals capex minus D&A plus change in working capital. So compare this with the previous one, you see, hey, the change of debt actually is included in this operating earning-based calculation, then divided by after tax operating earnings. That is profit belong to both shareholders and debt holders. And return on capital equals after tax operating income EBIT times 1 minus T divided by total assets. And if the company has lost cash assets, then you need to use net total assets. total assets minus cash assets. So we have three variation estimating future growth rates depend on which perspective that you are going to utilize. The first one is based on earnings per share. You look at retention ratio, assuming that all return earnings will be invested in future investment projects by the company. So if that is the case, then you can use retention ratio times ROE to get estimation of the growth. And the second approach is to look at the reinvestment based on net income. Reinvestment based on net income. You use the active reinvestment rate multiplied by ROE. And if the company has a lot of cash, then you want to use non-cash based calculation, which exclude cash from calculation of book value over the equity. And in operating income-based model, you do the similar thing. You exclude large amount of cash to calculate total value of assets or total value of capital. So we have three variations in this fundamental growth rate. And the first one is the most it's a well-known, popular equation, but as a professional, you want to get into great details, trying to get the best estimation, which is as the real investment from equity side or from the asset side. So yeah, let's and here's one example estimating growth rate for a specific company. And actually, I want you to go through the illustration, the chapter 11. This Coca-Cola in year 2010 is from the textbook, and I want you to look at this example to see how you can get a reasonable estimation of the growth rate based on this fundamental approach, which emphasizes the importance of investment, whether it's from equity perspective or from operating earnings perspective. A little bit calculation, yeah, but it's pretty straightforward. Alright, so that's a pretty easy chapter for you to go through. Once again, I want you to go through illustrations based on this fundamental approach. And although it's an easy chapter, it doesn't mean it's an easy issue for you to deal with in the future. Actually, this is one of the hardest issue for financial analysts to deal with in their stock valuation. The discount rate is important, right? And we spent so many time and we went through a lot of chapters, make sure we get this squared, the discount rate, because discount rate has something to do with risk-free rate, ERP, beta, so on and so forth, right? And but even discount rate, when you compare discount rate and the growth rate, I would say they are equally important, but for some growth companies like Tesla, and this estimating growth rate is even more important than estimating that discount rate. Although it's a small chapter, but I want you to pay a lot of attention to the method that we are going to utilize to estimate the growth of the company. So in your toolbox after this chapter, you have three main tools that you can utilize to tell what is the reasonable growth rate in a company. The first one is historical number, right? And the second one is what other experts are saying. Financial analysts' opinion on those growth rates. You should look at it at least, although you may not use their numbers, but you really want to look at it. And keep in mind that majority of financial analysts are overly optimistic. So if you see on average growth rate estimation for companies 12%, well, you should say, hey, those people may be overly optimistic. Then what about me adjusting their estimation downwards a little bit, maybe by 15%, 20%, 30%? After you look at, third tool. What is that? Look at the fundamentals. How companies are going to invest. Only investment can generate growth. And here you have a lot of work to do. You wanted to look at a quarterly report. You wanted to look at the transcripts for earnings release conference to see what's management's plan for their capital expenditure. Capital expenditure, that's a key word. Capital expenditure. Then you do your calculation based on three variations of this fundamental approach. Based on first one is retention ratio, right? Based on retention ratio, and the second one is based on active investment rate, which is the more accurate, and the last one is based on operating income reinvestment rate. So that concludes chapter 11. You will have three more tools to utilize in estimating growth rates: historical approach, analyst approach, and most importantly, the fundamental approach. And within this fundamental approach, you have three variations. So that's chapter 11. My name is Kevin Zhao, your finance professor at MTSU. I really enjoy my time with you guys and hope you enjoyed this video. See you. Bye-bye.